Hello and welcome to lesson 2 for the unit 3, which is called finance. Now in the last lesson we looked at the strategic role of financial management. So we looked at things like the objectives of financial management, and those were profitability, liquidity, solvency and growth. Now in this second lesson we'll look at the influences in financial management. So we're looking at how a business is able to obtain finance, able to grow and develop the business. Internal funds are the first source of finance for a business. And internal funds are those obtained from within the business. And there are two main sources of internal sources of finance. Those are retained profits and owner's equity. So let's have a look at retained profits to start with. Retained profits are the share of the net profits. So that's the profit that the company makes after expenses, after taxes, and which have not been paid out to shareholders as a dividend. So it's the money that is kept in the business and is retained by the business. The second internal finance is owner's equity. That's the money which is contributed to the business by the owners. Now that might be in the form of capital, money, or the purchase of shares. And there are a few main sources of owner's equity. For a typical company which is a sole trader or a partnership, that's going to be in the form of cash. Now it might be cash from the owner's savings account. It might be money that the owner borrows from a bank. And importantly, if an owner borrows money from a bank and invests that money into their own business, the owner is liable. So the owner is responsible to pay that money back to the bank. The business is not liable for that amount of money, so the loan taken from the bank. Another way to get a source of finance internally is to take on a new partner, and that new partner may invest money in the business. Now for a private or public company, this is a little bit different. A private and public company will probably be able to generate revenue for the company internally by issuing more shares. Now, issuing of shares will raise more funds for the business, and that's a source of revenue. Now, we've looked at internal sources. There are also some external sources of finance for a business. External funds are those which are provided outside of the business, and there are two main ways that can happen. The first is through debt financing. That can be short-term or long-term. And the second way is through equity financing, and we're going to look at both of those. Debt financing. That involves borrowing money from other people. Usually that's a bank or another financial institution. And you can do that in two ways. That can be done short-term or long-term. Now a short-term would usually be less than 12 months. And that would be to pay for short-term debts. And that could be wages for employees or invoices that needed to be paid in the short term. A little bit like making sure the business has liquidity, which we talked about before in the objectives. Now the long-term borrowing would be borrowing for more than 12 months. And that might be investments such as plant and equipment. Could be vehicles, could be machinery. And ideally, the repayment of that long-term borrowing would be matched against the earning potential of the asset that is being bought. So if you bought a piece of machinery, you'd make sure that your repayments matched the revenue generated by that particular piece of machinery. Now, short-term borrowing. How do businesses achieve short-term borrowing? What mechanisms do they use? One of the first ones they can use is a simple overdraft with their bank. So it's an agreement with the bank that allows a business to withdraw more funds than they have in their actual account. Now it allows the business to meet immediate needs if they don't have enough funds in their bank account. But there are conditions. One of the conditions might be an upper limit set for withdrawal. The bank may charge a fee for the service. And usually the bank would require some security. And that may mean in the form of access to a business's assets. so that if the money is not paid, they can claim against some of the assets of the business. The second way a business can generate some short-term borrowing is through bank bills. Now, a bank bill is not a very difficult thing to understand, and the best way to think about a bank bill is to look at it as an IOU. A business would issue a bill via the bank, so agreed upon by the bank, to an investor. And let's say, for the example, the investor had $100,000 that they wish to invest in the business. The business would give them a bill which showed the amount, $100,000, the period of time where they would invest the money, in this case, let's say 90 days, and the interest that the business will pay the investor for lending the money. So a business would then receive $100,000 of cash investment, which they could use to fund medium-term development or meet any of their short-term needs to make sure they have liquidity. And then after the 90-day period, the investor is paid the $100,000 back, plus 10% interest. So they receive $110,000. The business then effectively would have received $90,000 to invest. It's a good source of borrowing, and it is also agreed upon and factored in through the bank. Talking of factoring, another way of short-term borrowing is a mechanism called factoring. Now, we looked at this in Year 11. Factoring is where a business will sell the money which is owed to them by their creditors to another business. And that business is usually a debt collection or factoring business. So in the example I showed you on the screen, if a business had $50,000 which is owed to them by other businesses, they could sell that debt to a factoring company. Now, a factoring company would not pay $50,000 for that debt. They would probably, depending on the agreement, in this example, give $30,000 to the business immediately. And then the responsibility to recover that debt would be at the hands of the factoring company. They take the risk, and because of that risk, they charge a fee, in this case $20,000, to the business. Now, the benefit to the business is that the business receives cash very, very quickly to invest back into the business, probably to meet those short-term financial needs.